In this example, we're going to focus on being the buyer in a retail business. So again, the company has to kind of wear two different hats. We have to buy inventory and then we have to be able to sell it. So depending on who we are in that situation is going to impact how we record our journal entries. So it tells us that our company is a women's clothing store. We've purchased $73,000 of merchandise from a supplier on account. The terms are FOB destination, 210 net 30, and then they returned merchandise with an invoice of an amount of $9,900, receiving a credit memo. So let's take this a little bit step by step. So number one, we have shipping terms. So our shipping options are FOB destination or FOB shipping point. FOB stands for free on board. So FOB destination means it's free on board until it reaches its final destination. So when that happens, that means the seller is going to pay for the shipping charges. When it's FOB shipping point, it means it's free on board only until it hits its shipping point. Then it's the buyer's responsibility. So then the buyer has to pay for shipping. So in this case, again, we are the buyer because we're making a purchase. Our shipping terms are FOB destination, so the company that we're buying it from is shipping it to us for free. And then they're telling us when we have to pay them. So anytime you see any variation of accounting of credit terms, it automatically indicates that that purchase was done on account. So 210 net 30 stands for a 2% discount if the balance is paid in 10 days. The net is the N stands for the outstanding balance then is due in 30 days. So no matter what, I have to pay this company back in 30 days. But if I can pay them sooner than that, I actually get to take a discount off what I owe. So for our purposes here, they said just to date all the transactions as of December 31st. So we're going to go out and we're going to buy inventory. So we're buying inventory of $73,000 and we're buying it on account. So we have our accounts payable for that same value. It then tells us that we are going to make a return. So we're returning inventory that had cost us $9,900, and we're getting what's called a credit memo. So basically, we're reducing how much we owe to this company sometime in the future. So we never paid cash to this company when we went and bought that inventory for $73,000. We said we would do this on account. We will pay them sometime in the future. So they're not going to give me cash back when I do a return because I haven't given them any cash as of yet. So instead, we're going to reduce our accounts payable by that amount that I'm returning. And what I'm returning is my inventory. I have less inventory now because I have in fact made a return. And then they said that they want us to record the payment within that discount period and then record the payment if they couldn't do it within that 10-day period. So let's look at the first one. So if we could pay them within that 10 days, that means we don't owe them as much money as we previously did. So the first thing that we want to do is when we pay off a creditor, that eliminates our liability to them. So we're going to debit our accounts payable. So looking at this information, I originally owed them $73,000, but then I reduced what I owed them by $9,900. So I have an outstanding liability to them currently of $63,100. That's how much I currently owe to them. We want to make sure that we're eliminating our accounts payable for the total balance that is sitting in that liability account and not for the amount minus that 2% discount. Because if we do that, it's going to show that we still owe this company some money, and we actually don't. We are satisfying our obligation to them by paying them within that 10-day period and therefore getting a little bit of a discount. We're going to have to send them some cash, but we don't actually have to send them the full amount. So we get to take a 2% discount. So we owe them $63,100, but we don't have to pay the 100% of that value. We only have to pay 98% of it, or 2% less. So we actually only owe them $61,838. The difference between the two is going to go into our inventory account. Remember, our inventory account is really trying to capture all of the costs associated with us acquiring our inventory. So when we buy the inventory, it increases our inventory account. If I have to pay for shipping, it's also going to increase my inventory account because if I don't pay that shipping fee, I'm not getting my inventory. And if it's costing me more to get my inventory, I certainly want to charge my customers more for it. If I have a return, obviously I have less inventory. We see our inventory account decrease. And if I'm able to take a discount, that also means it's costing me less to acquire my inventory. So that allows the company then to decide, well, maybe we can lower our price a little bit to attract more customers, or maybe we leave our price at the same amount and therefore we make a bigger profit. So the difference between how much I actually gave them in cash and how much I technically owed them in this case is $1,262. So it shows as a reduction to my inventory. And then if we couldn't pay them within that 10-day period, I'd still get rid of my accounts payable of that $63,100, and now I would owe them the full $63,100 in cash.